bond yields predict nor depict the consumer price index. Rather, they quite accurately forecast and realistically reflect inflation. That paradox, seeming paradox, was written by Jeff Snider, the head of global research. And in part one, which we just finished, we discussed the 1950s, trying to discern the difference between consumer price indices and increases there and inflation, what some crazy people call monetary inflation. That's totally redundant. In part two, we're going to be discussing a blog post by Jeff at Alhambra Investments. It was blogged and posted on the 22nd of October. The title is, Do Bonds Accurately Price Inflation? Since before any of us were born. Now, Jeff, let's talk first principles, though, because in the beginning, you said that inflation is always and everywhere a monetary phenomenon. This is kind of like asking, well, why does gravity pull us down towards the center? But Jeff, why is it always a monetary phenomenon, inflation?
Because without an overflowing, condition of money where there's too much money chasing too few goods, if there isn't too much money, eventually, we have consumer price changes all the time. We live in a dynamic world. It's a dynamic economy. But if there isn't that kind of monetary background, then what happens is you might get a burst of consumer prices, but eventually the economy will have to adjust to them. And over time, that adjustment will cause other prices to be dragged downward. So you have a balancing act. So you could have a rise in the CPI for a short period of time, but unless it's monetary version of inflation, actual inflation, the economy will adjust to it and eventually prices will calm down or even come back down in certain cases. So if it's not money, it's not really inflation. So if it's not really inflation and consumer prices are going up, then we would say they're probably not going to be able to go up for very long before the economy has to adjust to them, which usually means that whatever's causing those prices, once everything's adjusted to those causes, those non-monetary causes, consumer prices will calm themselves back down again because, as Milton Friedman said, actual inflation is a monetary phenomenon. So no money, no inflation. Therefore, if it's not money, it's not inflation, consumer prices must be for some other reason, and those reasons are going to be transitory.
Without the money, it won't be so. Whatever else has to be responsible for consumer prices can only ever be transitory. First principles, Jeff Snider. All right, Jeff, we have a graph that we looked at in the 1950s. We discussed that in part one, but we really only discussed the first half of the 1950s, didn't we? And it's starting in the second half of the 1950s when we start seeing money being created out of thin air well, we're not quite sure where it was happening, but definitely in Europe, Britain, Japan.
Well, we know where it wasn't happening, right, Emil?
No, where?
I think that's an important point too, and it's a common misconception that lingers on to today. People think that the Fed prints the money. The Fed is responsible. The Federal Reserve, central banks are printing money, and it's important to point out that no, it's not Federal Reserve. It's not the central banks that print money. It's the private banking system. So if we're talking about inflation, where does the money come from? Inflation. Well, we can blame the Fed, but not for printing the money, but we blame the Fed for not stopping it, because that's really what its job would be. Say, hey, you commercial banks are printing too much money. You need to knock it off, and we're going to penalize you for doing it. That's not really what happens. It's commercial banks print money that nobody really knows is money. Therefore, central banks are sitting there with their heads up their butts saying, we don't really know what's going on here either, so we'll try to do something else. So that's really important. We don't know where the money's coming from, but we know one place it's not coming from.
Looking at this graph, so you've got consumer price indices here, the consumer price index, plus various tenors of the US Treasury market. And in the 1950s, if we look at it, we can see sort of a three-hump camel. From 1950 to 1954, we see a rise and fall. 1954 to 1958, a rise and fall. And I'm describing bond yields. They're rising and falling. 1958, 1960, another hump, rise and fall. But each time putting in a higher high, higher low, and rising, because in the 1950s, as we've discussed in lots of other episodes, money was being created out of thin air. And you would think it would just continue. But then now we're transitioning to the 1960s, and we had a little bit of an interruption. Why did the the rising hump, 3-hump camel, not turn into a 4, 5, 6, 7-hump camel starting in the 1960s?
Well, first of all, going back to the pre-1950, middle 1950s, the bond market essentially ignored these inflation panics by the Fed, right? We talked about 1936, we talked about 1947, and again in 1950. So consumer prices go through the roof, bond yields don't move. Somewhere around 1955, that begins to change, where the bond yields start to go up, not just at the long end, but also at the short end, anticipating something. And as we know, Irving Fisher said in the early 1900s, long-term bond yields decompose into growth and inflation expectations. So the bond market began to sniff out this transition in the middle 1950s that said, we're starting to see yes, definitely more growth expectations because things were very good in the 1950s, but also maybe a little bit of inflation expectations too. And you're right, Emil, in the last part of the 1950s, you can see, I think it was 1957 forward, there's a very distinct difference between the way the consumer price index behaved in that period, 1957, 58, 59, compared with 1950 or 1947 or 1936. There was nothing in 1936, but certainly not 47 and 43, I believe, was the other war shock too. So you see consumer price index just spike, and then it comes way back down. But that happened in 43, it happened in 47 and 48, and it happened again in 1950 and 51. But in 1957, it was sort of, okay, no longer just a quick spike. It was a kind of a slow build rise. It didn't get very far before there was a double dip recession in the last half of the 50s. And that's kind of what interrupted bond yields and led to that low inflationary period in the early 1960s. But already the bond market was starting to say, something is different here. The last half of the 1950s, yields were behaving differently, and the consumer price index was behaving differently than it had before 1955.
And, there are different opinions as to when this started. Catherine Schenck wrote a paper that pointed to Midland Bank in 1955, in the summer of 1955, that they started doing Eurodollar. They started offering dollars that maybe weren't on hand exactly, offshore dollars. And then Paul Einzig said he wasn't quite sure when it happened, but writing in the early 1960s, he said that already by the late 50s, this was taking place in London, this dollar creation business. So incredibly, the bond markets were sensing something. But we're entering the 1960s, everyone's favorite decade, and we begin it with a recession in the United States. So yields fall down, and then they stay sort of flat until 1965. I guess they were flat to rising, while inflation was flat and well below 2% this entire time. What can you tell us about the first half of the 1960s?
Yeah, again, it was a low inflationary period simply because of a lot of idiosyncrasies involved with that time, government fiscal deficits, things like that, fiscal sanity. Plus, there's this evolving globalization trend where there's dollars flowing outside the United States for reasons that certainly central bankers and many quote unquote experts didn't really fully understand or even really have any idea that was taking place. So you have a sort of a monetary black spot too, that by the latter part of the 1960s, as we've discussed before, this Eurodollar system, this developing Eurodollar system, more and more started to bleed back inside the United States as well. So you have bond yields that are sniffing out this monetary change in the 1950s, and then it sort of kind of goes quiet for a while. And then those dollars start to come back home into the United States. These are offshore dollars that US banks were borrowing from outside the United States. And suddenly you have a monetary phenomenon that by the 1963, 1964 is becoming a big process. Central banks the Federal Reserve in particular, starts talking about Eurodollars a little bit more. And as bond yields are rising, the consumer price index wasn't. It wasn't until 1966, 65, where the CPI went up, but yet bond yields were starting to rise as far back as 63. So again, the bond market started to say, something's changing here a couple years in advance of what was coming, which was the very leading edge of the Great Inflation.
And so for the second half of the 1960s, we see the consumer price index rising and bond yields rising, and we would implicitly assume, well, it's rising because of the consumer price index. But we're making the point here, unlike some earlier episodes, this time we've got monetary creation powering this. Okay, now we're heading into the...
Yeah, and just to make the point again, to point out that the way actual inflation developed was very distinctly different. You don't see these very short-term sharp spikes in inflation. It's sort of just, it starts and then it goes on and on and on and on. And when you map the CPI changes against these bond yields, what you see is bond yields rise in anticipation of the slow burn of actual inflation captured by these CPIs. And so bond yields are reacting, or actually they're being proactive about monetary inflation because they, again, what goes on in the bond market is those who create the money are expressing their opinions on safe and liquid instruments. So if the money creators are saying, we don't want safe and liquid instruments, we're going to sell them and have yields rise, anticipating that consumer prices are going to reflect these economic circumstances, that's a very clear message from the monetary system itself in advance of what's going to happen. And so, it's not just that the CPI goes up, it's why the CPI goes up. And you can see the differences in how the CPI goes up too.
Especially in the next graph that we're going to look at from 1967 to 1976. And what we see is, again, bond yields rising steadily. But very interesting, Jeff, there's a two-part story to this decade that I've picked out here. In the first half, we see consumer prices and bond yields in agreement. But then, just when you would think that bond yields should roar higher when there's a oil embargo and chaos in actual consumer prices, it sort of ignored that surge. The bond yields kept rising, but not with the escape velocity to the moon that we saw in oil prices and consumer price indices.
Yeah, we had the recession in late 69, 1970 that knocked a little bit off the consumer price index, and it didn't really change core consumer price index rates at all. And we talked about this in a previous episode. President Nixon and the what did he say? The liquidity explanation was bullshit. I mean, the Oval Office tapes, all that stuff. Arthur Burns talking about 1970 recession, how it seemed like the laws of economics were no longer holding. Well, all they needed to do was look at bond yields. Bond yields were absolutely obeying the laws of economics. It's just that Arthur Burns didn't know how money behaved inside these laws because money itself had changed. But those trading in bonds absolutely know the evolution of money because they're the ones doing the evolving. And so aftermath of the 1970 recession, almost very quickly, some people were thinking, well, maybe the inflation episode is over with. Bond yields started to rise in anticipation of it resuming, even though it took almost, I think, about a year before the consumer price index started to reflect the renewal of the great inflation. Bond yields were already on top of it beforehand. So that was the out of control money part. And then in October 1973, bond yields are already up. Inflation, the CPI indexes are already rising pretty rapidly, pretty steeply at that point. And then in October 1973, you have the Arab-Israeli war, OPEC embargo, which simply added another supply shock on top of this other inflationary trend. And so what did the bond market do? As you're just saying, Emil, the bond market said, well, we're only trading on inflation. We don't trade on supply shocks. And again, it's the same exact patterns we saw pre-1955. Bond yields ignore the supply shock parts of consumer price index or consumer shock parts of the CPI and only respond to inflation. So that's why bond yields undercut the CPI starting in 73 and 74, because the bond market is separating the components of the CPI for us. It's saying this part's inflation, this part is oil embargo supply shock, and here we're telling you which one is which.
Guess what, Jeff? If you fast forward 30, 40 years to 2000 to 2021, which you do for us in the next graph, we can see that same process, but now in reverse. Now bond yields are falling, and when we have these temporary, transitory surges in demand prices, consumer prices, the bond market it looks through them. And there's several examples here. 2008, does everyone remember what happened to oil prices in the summer? The bond market was saying, no, we're heading into a global monetary shortage. Then 2011, QE is money printing. As I've once said before, it was the biggest liquidity event since the Little Ice Age, but the bond markets didn't think so. which would bring us then to the most recent time period. But before we get to the most recent time period, is there anything you wanted to add about 2008, 2011?
After having gone through this history, seeing how bond yields respond, and seeing how the CPI changes, it's more than interesting. It's actually very important to see how the CPI since 2007 looks more like it did and behaves more like it did before 1955. We've gone back into these short temporary spikes in the CPI, which the bond market ignores, because bonds are saying this is what's causing consumer prices to rise is not inflation. It's something else. That was absolutely nobody today would make the mistake of saying 2008 was inflationary, right? Nobody, yes, consumer prices rose often dramatically, but that wasn't inflation. Obviously, it wasn't inflation because we were in the midst of a deflationary recession. And it wasn't really a recession. So 2008, the bond market said this isn't inflation. It wasn't. 2011, everybody said this is inflation. Here it is. The money printing is coming home to roost. The bond market said, no, this is more like 1950 or 1947. Guess what? That's exactly what happened. So it's not just that bonds are behaving differently. Bonds are behaving differently than it had in that middle period between 55 and 2007 because something is different. And it's not just different in the bond market, it's different in how the CPI changes and evolves too. We've gone back to the CPI reflecting more like the pre-1955 era. It's almost like the entire system changed. Between 1955 and 2007, we operated one way, including the CPI, bond yields, all these other things. And then like 1955 and before, from 2007 to today, both bonds and the CPI behave differently.
And then in 2017-18, bond yields rose. They considered whether or not maybe there was going to be a recovery. It was called globally synchronized growth. There was an exploration of that possibility. They didn't rise as high as some of the other points that we see on this graph, but they were considering the possibility before turning south. And that brings us to present day, Jeff, which looks like so many of these previous examples. Basically, we have a tremendous surge in consumer prices, which, if you turn on your financial media, means inflation, means money printing, means the Federal Reserve has gone too far. Maybe they have, but guess what? We have this tool that is so shiny and has been used for 4 generations, and that tool says, no, this will be transitory.
Yeah, that tool says we're pre-1955. Both not just the CPI, but actual inflation as well as economic conditions, which if you remember pre-1955 was mostly dominated by the Great Depression and its aftermath, more deflation than not. So that's really what we're saying. I mean, what happened between 1955 and 2007? I mean, it's a mystery for the vast majority of the public. It's a mystery for central bankers and economists, but it's certainly not a mystery for anybody who's familiar with Eurodollar University, because that's the exact same period that the monetary system, this offshore monetary system, was in its most effective and over-effective operation. So, what we're saying here is there are no coincidences. This is not coincidence that bond market has been able to sort out these differences in CPIs, because the bond market is the monetary system itself telling you what it believes is going on in money and in the real economy. And so what the bond market said, 55 to 07, we're trading more on inflation, lack of inflation, actual inflation and money conditions. Whereas before 1955, as well as after 2007, the money's just not there. And if the money's not there, whatever's going on in consumer prices, it can't be inflation. It can't be a monetary reason. And therefore, it has to be something else. And because it's something else, it's not going to last. Now, when we say it's not going to last, that can mean a lot of different things. And we're not saying that consumer prices didn't go up. We're just saying it's not inflation. It's not money. It's some other kind of process at work here, which has very different implications.
And we're concerned, this is my final thought on part 2 here, Jeff, is if there's not money there, there's not going to be enough money to power the economy to grow at a rate that we'll be satisfied with. That's, I think, the real economic answer if we step out of, inflation and all that sort of economic parlor talk. For the real people, we're worried there's not enough money. That's what the bond market's saying. And therefore, the economic recovery is at risk, the reflation. We're concerned about it and whether or not it's going to be sustainable.